Hi, this is Chris Lewis from Hola Prime Academy, and in this video I'll talk about a very simplistic system I call the 80-20 system. I don't know that this is earth-shattering, but one day I was reading about how most traders are trying to get about 80% of the move in a trend to the upside or the downside. Basically, what the premise of the article was, you don't top tick or bottom tick a move. And in my 15 years of trading, I have done that maybe 5 times. It just generally doesn't happen. And that's okay. But I had to come up with a system when I was working full time. And when I first started trading, I was a contractor. So I was out on construction sites and I would be able to look at the phone every once in a while, but that was about it. So I had to come up with a mechanical system that I thought gave the best opportunity to make money. And I played around with the parameters. And what I came up with is what I call the 80-20 system. It does involve staying with a trend, and it has a very mechanical approach to either you win or you don't. But the amount that you are risking versus the amount that you are trying to gain in conjunction with the trend means that over time, I've found quite a bit of success with this very simplistic trading system. So let's take a look at some charts and I'll show you how to do this. Now, in front of you, I have the Australian dollar on a daily time frame with a 20 exponential moving average. And the point of this is to suggest which way the trend is going. And then we use a very mechanical system from that point to show exactly how we should be getting in and out of the market. So in this case, I'm using a 20-day EMA. You could just as easily, and I'll change it now, do a 50-day EMA. And it really comes down to how quickly you want to be involved in the market. So that is one aspect that you will have to somewhat agree on before starting. So the 50-day EMA is a little slower to move to the upside or downside than the 20-day EMA. And then what I do is once I zoom down to the 4-hour chart, I ignore the moving average. I just use it on the daily. So on the 4-hour chart, it really doesn't mean anything. And then I start to plot out big round figures. Big round figures are great because a lot of people pay close attention to them and use them as a place for stops or options orders, those types of things. So there is a lot of work to be done around them. So I'm going to plot some of these uh, big figure numbers here. So 0.65, for example, and 0.66. And this is just a quick on the fly type of example. 0.67, etc. So you have every 100 pips. Now you want to go with the daily trend according to the moving average. So I will go ahead and make a line about here. This shows that we entered an uptrend, and we're kind of flirting around with it right now, trying to sort out what to do with it. So I will zoom back in on the 4-hour chart, and then you will see those lines reappear. And when we get there, you can see this is our example area. Let me go ahead and put 0.68 as well, because it was also in play. So as we started to swing in the uptrend, we pulled back a little bit, and on the daily, we started to swing to the upside. So, what's a way that you can perhaps join the trend without worrying too much about anything other than your directionality? Well, one way you can do it is place an order at the 20 level. So what I mean by this is 0.6620. So you would have been a buyer there. You would have been aiming for the 0.67 level, which is now your take profit. And you would have put your stop loss somewhere just below the big figure of 0.66, maybe in this case 10 pips. Again, there are some parameters that you need to decide what you're comfortable with, but this is a perfect example of getting involved in the market mechanically. You can see we broke above there on this 4-hour candlestick, and then the next thing you know, we went straight up. You were risking 20, maybe 30 pips, depending on if you gave it the extra 10, and then you're gaining 80. Some people will just use the big figure that I have taught this to, and that's where the name 80/20 comes from. That's where I started. If you're a little bit more risk averse, then maybe it should be called something along the lines of 80/30. It really comes down to how you want to approach this. Notice the 0.67 level was broken, and you're still in an uptrend, and you would get involved right about there. And this is what I meant by a little bit more conservative with your risk appetite. So depending on how you played this, if you did the 10 below the big figure, the extra 10 pips, when this market took off to the upside and pulled back, it kept you in. If you had your stop loss at the actual entry point at there, once it took off, you got stopped out at break even. Some people like to move their stop losses up quicker, but if you're more mechanical like I am, you entered here. If you had your stop loss at 0.67, you lost 20 pips. That's it. If you had your stop loss at 0.6690, like I said, giving it a little bit of room, the 30 pips, you stayed in, and then the next thing you know, you ended up taking profit at 0.68. So again, you either risked 20 pips or 30 pips, but you're gaining 80. Let's take a look at another chart. So in front of you, I have the dollar against the Swiss franc, which has clearly been in a major downtrend for months. So how do you take advantage of this? You wait until the moving average starts to drop. You can see that there was a trend change. And notice here, this is where you have to be careful. And this is where the idea of a mechanical trading system will keep you out of a lot of trouble. Because once we turned lower, right about there, we did have a pretty significant pullback. But notice we've been dropping ever since then. So I suspect what you'll probably see as I drill down is that the first trade or so may have taken a hit, but you've clearly made plenty since then. So let's go ahead and go down to the 4-hour chart. I will take the auto scroll off so you can see it. And right about there is your entry. As you enter into a downtrend, I should say. So then we look for a big figure. In this case, it'll be 90, 0.90 that is. So we start shorting in this area right about here, or perhaps Depending on how this played out, you may have shorted on the way back down. Let's go ahead and say you shorted here. The question then becomes, do you take profit before you get stopped out? And even in this case, it looks like 89 or 0.89 was in fact hit. And in fact, in this particular case, you hit that rather hard, and your stop loss really wouldn't have mattered if it was at the 0.90 level or the entry point of 0.8980. So again, you're just looking for 80 pips. You're trying to risk only 20, maybe 30 if you want to be a little bit more conservative, and then you hit that price. We did get this nasty bounce. So had you entered here at 0.8880 and aimed to get down to the round figure, you would have taken a loss. Notice how we've reached here. And then once we head back down, because remember, you're only trading in the direction of the moving average on the daily chart. So you wouldn't short it as soon as we hit this area. But once we break back down it, going in the same direction as the 50-day EMA on the daily chart, you would have the exact same setup you had here. So you break through the 0.8980 level, you come back, you touch the 0.90 level. So depending on if you use the 20 or 30 pip stop loss, really kind of comes down to whether or not you broke even or if you got stopped out with a minor loss. If you chose the more conservative, meaning 30 pips instead of 20, you're giving it a little bit of room there, you hit your target. And you can see that depending on how you got involved at 0.8880, you may or may not have gotten stopped out the first time, but the second time it ended up being a huge winner, and on and on. So the point of this system is you're risking 20 to gain 80. If you're a little bit more conservative with your stop loss and you're not so aggressive, you're willing to let the market float a little bit, like I tend to be, then maybe you add an extra 10 pips. But worst case scenario, you're losing 30 and you're gaining 80. That's still more than 2 to 1. The trick to this, of course, is going to be that you must trade with the daily direction. You will find that there are going to be times where things get a little bit tough. And that is generally when you're speaking of a trend change. Like in this area here, without running through it, I'm pretty sure you may have taken a loss or two, but they're small losses, and that's the point. Just like you can take this trade multiple times to the downside, you end up winning quite a bit more than you lose. A final thought is that sometimes what traders will do, and if you're in a longer term trend, when you get to your take profit point, a lot of times what will happen is it will go up to the next entry point, another 20 pips higher, and I might put a second position on, but it might be like a third the size of the original one. So it doesn't really hurt me if it does get stopped out and I can stay in that longer term trend. There's a million ways to slice and dice this, but this is something I wanted you to think about because it's been so helpful for me. I can set the entry point, go to work. If I'm still a contractor, I can set the stop loss and the take profit, just come back and see what happened. That takes a lot of the psychology out of this trading scenario. And when you catch a trend, you'll find multiple opportunities present themselves over the course of days, weeks, even months. If you get a really good trend, like we had seen in this particular chart in dollar Swiss, this on the weekly time frame, you can see it's dropped about 7 handles. So you can see how helpful it can be if you're really attuned to what is going on longer term. Same thing over here in the end of 2022. The market then decided to plunge 14 handles. A lot of opportunity. Again, this is a trend following system, so make sure that you get a drop in your favorite moving average. For myself, I use the 50-day EMA on the daily chart. If you choose to use the 20, that's fine. Just recognize that it's a little quicker to move and therefore it may not be quite as reliable. I know people that use the 200-day EMA that I've taught this to, although it's probably worth noting that they don't get anywhere near the amount of trades because it takes so much time for the moving average to roll over and start heading in a direction sometimes.